All right, hello everyone. Happy Monday and welcome to the weekly market check-in with myself, Greta Wall, and T3 Live's and T3 Trading Group's Derrick Oldensmith. He's the leader of T3 Live's Pro Desk Virtual Trading Floor and a professional prop trader with T3 Trading Group. Derrick, it's been a while. You were on vacation, but welcome back. You had last week to get back into trading and get yourself more situated with what's happening in the markets. How's it going so far today?
It's going well. Like you said, I was on vacation for a couple of weeks. It was great. I really took a half step back from markets. So I was a little bit paying attention to things, but very much trying to not trade. And I sized down all my swing positions before I went away, which I think cost me a bunch of money, honestly, but it was worth it a little bit, I think, to just take the step back. And then now I'm back as of last week, and I'm refocused on our current market, which is an interesting.
Yeah. Always important, I think, to actually let yourself check out and let yourself have like a brain reset, because traders don't get a lot of that. It's hard to actually take time off. Derrick, like I mentioned, is a professional trader with T3 Trading Group. So here's a look at the current positions that he is in for disclosure purposes as we talk about any tickers throughout this live stream. These are everything that Derrick is currently trading in. All right, so Derrick, we are trading after the Fed cut. We've, of course, had a few sessions after the Fed cut last week, but this is our first full week after that much anticipated cut from the Fed last week. I feel like the past like 2-3 months of trading have just been like, are we going to get a cut? When are we going to get a cut? Is it going to be 25 basis points? Is it going to be 50 basis points? Now it finally happened. What was your reaction last week to that, supersized cut we got from the Fed, and how the market has reacted in, the Thursday session, the Friday session, and now today?
Sure. So 50 basis point cut. It was the first time we went into a Fed meeting without it being like perfectly priced into the market on what that cut was going to be or what the Fed actions were going to be. So there was a little bit of a surprise to the markets just with the 50 basis point cut, though we hit a point going into it where 50 basis points is more expected than 25. There was still a degree of uncertainty. So on the Wednesday in those last 2 hours after the Fed cut interest rates, we didn't trade great, but Thursday we gapped up really, really big. And by, highs on Thursday and into Friday morning, the market was a little bit extended to the upside. Friday was also a very important OPEX. In some ways, I almost feel like the OPEX on Friday was as important as the Fed cut on Wednesday for markets in the short run. So we had quarterly OPEX on Friday. So a whole ton of options on different timeframes expired on Friday for different products. And here we are with this market now. The reason why the September OPEX is important is because the 2 weeks after it are traditionally some of the most seasonally weak periods of the entire year, if not maybe the most seasonally weak 2 weeks of the entire year. We're starting today. Yet the S&P, if you look at the daily chart of the S&P, it looks very, very bullish. We went to all-time highs on Thursday. We digested it on Friday, and we're continuing to hold up today. The market is small green as we're talking. So I'm trying to justify this seasonally weak period that we're entering into right now with these pretty bullish looking technicals in the market. But at the same time, it doesn't feel like we're getting any real upside momentum follow through on this market either, which on the surface of things you would almost expect after a 50 basis point cut. So I'm being a little bit more of a sniper right now in this market. I've got some longs on and some shorts on. I think from a portfolio swing perspective, I'm like fairly neutralish right now. And I'm really just waiting for the technicals to give me more clarity because the technicals are bullish, but I'm not convinced that they're not going to fail. So I want to see if we can just kind of hold above the recent breakout levels for a few more days. That will start to increase the probability that we break higher. Or I want to see if we actually fail back down to the levels that we broke out from, which would be a major signal that we might start to work ourselves lower, as what normally happens in this period of time of the year.
Mm-hmm. Can you go through some of those levels that you're monitoring personally?
Sure. So if you can share my screen. So just pulling up a daily chart of the SPY here. So you can see Thursday's really big gap up was on the 19th. So the major kind of level that we broke above is like SPY 565. We actually perfectly retested SPY 565. Low of the day on Friday was 565 spot 17. We like perfectly retested it on Friday. But Friday was also an ex-dividend day for the SPY by like $1.75. So actually never really, if you include the dividend or if you looked at a chart of the S&P cash, perfectly retested the level in the way that my SPY chart looks like. But broadly, that's the level that I'm looking at. I'm looking at this SPY 565. The ADMA is just about caught up to it now. So if we really start to lose 565, and maybe you need to give it a little bit more leeway than that because of the ex-dividend that happened on Friday. But if we really start to lose 565, I think that starts to indicate actually a fairly bearish outcome because you would be losing any bullish move that happened from the Fed at that point, and you'd be losing the technical breakout to all-time highs that we had on the Fed. So I'm really paying attention to, let's call it the 563 quarter to 565 zone on the downside, where if we lose that, I think it becomes a major problem for markets. But currently we're above it. So the other thing I'm trying to see to potentially confirm the bull thesis would be if we can just hold above those levels, hold above Friday's low for a couple more days, confirm it, let these moving averages catch up a little bit further, then maybe we're actually setting up on the long side. Traditionally, you know me well enough, Greta. I'm usually an optimist. I tend to be bullish on the market. I'm actually not as bullish right now as I oftentimes am. I'm very nervous about a deeper pullback or an increase in volatility really between now and the election, which we have a little bit over a month from now. So I'm trying to stay two-sided on the market. I'm doing a little more, singles and doubles, day trading scalps to put some cash flow into my pocket while I just kind of wait for more broader clarity. And if I really see some weakness come in, I'm not afraid to hit it because I think that we're in an environment right now where if we really break up out of this bullish pattern, there could be a lot of momentum that comes behind that breakup because the data that I've seen shows that a lot of the hedge funds and systematic funds are fairly under positioned right now. So they might have to chase back into price that could create big upside moves. But I think that the flip side is also true as well. If we really lose those levels and we break down, I don't think it's like a very quick, shallow dip that you want to come in and buy. I think that there is room for this market to really trend down and have momentum down as we're in a seasonally weak period, as we're in a time when the buybacks are in a blackout window. So your corporates aren't doing buybacks in the same way. That blackout window lasts for like another month. Also begins to kind of coincide with us getting through election risk. And then if we can get through the election without any major issues, then I get more constructive and more bullish into the end of the year. That's kind of my big picture thought process and thesis. But on the small picture right now, I'm just kind of being a little bit patient. I'm not jumping in, full long risk similar to where I was before I went on vacation.
When it comes to the Fed stance at this point for the market, Jerome Powell really painted it last week as this is not like some big we are behind rate cut. We're normalizing rates. We're getting back into normal, whatever. So, you hear that the Fed is data dependent for so many weeks, but now it feels like the market is very data dependent on how they're going to feel about upcoming rate cuts based on jobs numbers and PCE numbers and CPI, but of course, jobs being like the really big focus. We're getting some more economic data this week. I think the GDP is on Thursday, and then Friday's the PCE. Do you feel like these numbers are more important, less important, after last week's Fed rate cut for the market?
It seems like every number matters these days. Obviously, the market's trying to figure out whether or not we're going to get, more 50 basis point cuts or not. I'm currently in the thought process that we'll see 2 more 25 basis point cuts this year. But like the Fed always says, it's data dependent. So the interesting thing about the Fed announcement last week and the subsequent reaction to it is that we got a 50 basis point cut, but the TLT, which is just the ETF that I look at for a quick snapshot of what interest rates are doing, the TLT is basically headed straight down for the most part. Maybe it's creating a pivot low today, but it has headed straight down, which means that interest rates have moved up ever since that 50 basis point cut. So you clearly have the market thinking that Powell wasn't quite as dovish on future cuts as the market wanted or expected, or at a minimum, it was like a buy the rumor, sell the news thing for bonds. So since we did that 50 basis point cut, we have seen interest rates actually move higher from the perspective of the treasuries. And then what that in turn has done is we've seen some pockets of IWM weakness, big rally into Thursday. And then since then, we've seen some pockets of weakness in some of the more interest rate sensitive areas, which is not what you would have expected on the surface of things with an actual 50 basis point cut. But here we are, and the Qs and big tech have continued to more or less hold in, and the SPYs are making all-time highs. So that's where my head's at. The numbers are important because it's not impossible for us to get another 50 basis point cut. But I think that everything that we're seeing from Powell and from the little bits of Fed speak that we've seen so far today are really indicating like, hey, the job part of the mandate and the employment part and the inflation part of the mandate, the risks are fairly in line right now. So we're going to take this step by step, and we're going to make sure that our cutting doesn't make inflation go through the roof again, and we'll take it slowly and do 25 basis point cuts. I honestly, even though I've been calling for cuts pretty much the entire year, didn't love the fact that they did the 50 basis point cut to begin with. I think they should have just started in July with 25 basis points and added on another 25 basis points, because now when you do that 50 basis point cut, you're kind of setting the precedent to the market that, hey, 50 basis point cuts are possible. And I don't think that that's going to be the norm. I think that as we work our way back down to more of a neutral rate, it'll be 25 basis points at a time. Let's make sure that inflation is not getting back out of control, but watching employment at the same time and taking it one step at a time. Unless you see a big recession coming on the horizon or major misses on unemployment, I think we'll be seeing 25 basis points going forward.
All right, so we're pretty much at the tail end of earnings season, and then another earnings season is going to start right back up. But there are some important numbers still coming out this week, mainly Micron being the one coming up this week. If we're talking about chip makers still being a major focus with NVIDIA, AMD, that whole world, Micron, of course, is part of that. Are you focused at all on the Micron report and what it can do to other tech names? Anything?
Yeah, so Micron is a name that I trade from time to time. I don't have a position in it right now. There was a sell-side research note out last week, and I honestly don't remember who it came from, but basically provided some information that said that Micron right now is fairly under-owned and fairly disliked by a lot of the bigger funds that are out there. And that was actually part of a bullish case that sell-side analysts laid out, as the stock has decreased from a price of $157 in June to $90-ish now. It was as low as 84 last week. It's trading at 93 right now. So the stock has had a major pullback on a percentage basis and is kind of disliked going into this report. I think the risk is to the upside on Micron. I'm not going to take a position into the earnings report, but if I was going to, I probably would rather be long than short. Obviously, make sure that you're managing your risk and it's appropriate and everything else. Not necessarily advice to anyone to do that. Like I said, I'm not going to take a position myself. But I'd rather be long than short Micron off of these levels with the degree of the pullback that it's had at this point, and see if it can continue to hold $90, which is a major level that it is now trading above as of yesterday, as of Friday.
So as we're starting this more like seasonally weak period, you went through the levels that you're looking at on the SPY, but what are some of the specific names that you're focused on when you're looking at ideas every morning? Of course, I know you go through a ton of research in the morning and do your morning meeting with the VTF. So what are you focused on as a trader specifically right now?
So it's still about finding where the relative weakness is coming into this market, and we have seen some relative weakness in the IWM and some more interest rate sensitive stocks. I currently have short positions in the Qs, and then I've got very small short positions in Nvidia and Tesla. Nvidia actually just broke out. It's super strong, so I have a just a cute little small short on in there. But Nvidia's been acting very weak, and I'm not sure to what degree Micron will influence Nvidia. I think it'll be fairly minor, but Nvidia has not been trading well recently. It had a incredible day when I was on vacation on September 11th, when there was news for the entire market that day, and Nvidia basically though led the market higher, and there was a conference going on. But ever since then, it's been acting really weak. 120 is acting as resistance. And I'm really eyeing this like 115 area that it's been testing today. Or if Nvidia begins to lose that 115, you might be looking at a deeper pullback. For my smaller position that I have on right now, I've really just been having like a 110 target on my short. But given the relative weakness, I might look for opportunities to add for a deeper pullback in Nvidia and see where we can go from there. So that's one that is honestly very much on my radar. And besides that, I'm not sure. I need to see, because it's like I said, if the market loses those levels, it's an if. We're above those levels right now. So the higher probability is that we don't. But if we were to lose those levels, I want to see what leads us back down through those levels and focus on that on the short side. And that's a little bit, to be seen. But I have a feeling that could come from AI names and big tech names broadly. And I won't be afraid to take shorter term shorts in them. Again, come November, I probably don't want to be involved in that trade anymore, but to take advantage of some seasonal weakness, I'm always so afraid to short Apple. Why am I afraid to short Apple? I was short it earlier today because it's got $110 billion buyback. And why do I want to be shorting a stock? Can it pull back with a $110 billion buyback? Of course it can. It has many times in the past with a big buyback. But why do I want to be fighting when I know that there's an underlying bid to the stock? Why do I want to be fighting that? But the difference is right now, it's either already in or about to enter its blackout period, where for a short time frame here, I actually don't have to worry about fighting the buyback in Apple or really any of these other Mag 7 stocks. And it's as we're in a time when, again, if we break down, these Mag 7 stocks could lead that downside. The companies themselves can't buy them for that period of time, and I can potentially short them without having to worry about, well, Apple just turned on their buyback machine, so that's a wrap for me.
Do you feel like the buyback blackout changes the dynamics of these big companies from how they typically would trade?
Yeah, absolutely. It actually, I think it impacts the entirety of the market. You enter a period of time here, and this is what happens a lot post-September OPEX, where there's just less liquidity overall in the market. So less liquidity, less forced buying that's coming into the market, perhaps even some forced selling that has to come into the market in September and October from mutual funds, because a lot of mutual funds end their calendar year in September or October. That's what creates that seasonal structural weakness that you see from the market. And the market dynamics themselves, I've just been learning more and more over the years, are one of the most important things to be keeping in the back of your head while you're actually trading. And in November, I keep referencing November because I think November is the biggest month of the year historically for buybacks. Do I want to be fighting Apple to the short side when it's the company with the biggest buyback in the history of the universe, and it's the month where the most amount of buybacks happen? No. But if I was ever going to take a shot trying to short this, it would be in this period of time when there might be forced selling from certain areas, or at a minimum, not forced buying that's coming in from the corporates.
Yeah, that's great. All right, so let's reflect a little bit back on your vacation that you just took. I know it's hard for traders to tune out from the market. Everywhere you look, you could see a headline about the stock market. You could see what's going on in the market. Turn on your TV, you could see tickers across the bottom of your TV, depending what channel you're on. So it's all around. You went to Japan. correct? For your vacation was it 2 weeks you were gone?
Yeah, a little over 2 weeks.
So how did you set yourself up to actually tune out and to not be trading on vacation? How was this different than previous vacations that you've been on? And what do you think the benefit was for you as a trader coming back to the market after really taking some time away?
Sure. So I did something in front of this trip that I haven't done ever, maybe. So I really started like swing trading much more, which is probably 8-9 years ago now. Prior to that, I was more of a pure day trader, where I said, you know what, I've got all these positions on right now, and I was trading. I was trading huge P&L swings in this entire summer period throughout August. Big P&L swings on that huge down day we had, and then all the way back up. I had huge short positions on. I had huge long positions on. I said, you know what? I'm just going to take off a lot of these positions. And for some of the ones I still have on, I'm going to size them down to not necessarily insignificant numbers. I still had some P&L movement while I was gone, but numbers where I know that, like, the interesting thing about the vacation I did, I was going to Japan, is that, the U.S. market hours were all night over there. And I didn't like when I was in Greece in June, it was like, all right, I can trade the open a little bit. I can log in for the close real quick and then enjoy my vacation. It's not a big deal. But it's like, do I really? And then even when I was on my vacation doing things, I could keep an eye on my phone when the market was open and, see what's going on and make sure that there's no emergencies and things like that. Do I really want to be waking up in the middle of the night in Japan just to check in on a couple of stock quotes that I'm not overly actively managing anyway because I'm supposed to be asleep so that I can enjoy my vacation? The answer was no. So, and especially just I was having the biggest P&L swings of my entire career pretty much this summer. I was like, you know what, this is a great opportunity I'm just going to take a step back from it. And honestly, it really did cost me a bunch of money, but the wrong way to think would be to think about that. The right way to think is just about where I am today in the here and now. So I just decided, you know what, I'm going to close out like all these shorts that I have on. I was pretty short on the index level. I took off a bunch of the longs that I had. I downsized a bunch of the longs that I kept. And again, I just went down to an amount of sizing where I knew that I was just going to be able to enjoy my trip. And I still logged in a little bit every morning, right before I was going to bed, basically in Japan, just to see where the pre-market action was. I still made sure to read Pat's research note. My partner, the great Patrick Haw, posts a wonderful, incredible morning, like fairly macro-focused morning research note in our virtual trading floor every day. So just by reading Pat's note every morning and a couple other research notes that people were kind enough to send to me, I was able to stay pretty in tune with the market without actually being logged in and trading. So when I came back from my trip, I knew exactly what I wanted to do. I knew exactly how I wanted to begin to kind of reposition myself, or actually in this case, how I didn't want to begin to reposition myself, because with some of the uncertainty that we were already just describing earlier and the seasonal weakness as you come into the election in the second half of September, and the increase in volatility, and yet with where the market's trading at highs here, I didn't want to come back in and start layering in a ton of risk right away. So the Monday and Tuesday I got back in front of the Fed, I did almost nothing. Wednesday, Thursday, Friday, I turned it on a little bit, but I turned it on more, like I said, I'm doing more like quicker day trades right now than I've done in quite some time, just to try to generate some cash flow for myself while I get through this period of time that I think is a little more uncertain, at least for me, from the macro perspective. And, that's where we're at.
All right, great. All right, so for everyone who's with us, if you'd like to learn more about prop trading with T3 Trading Group and Derrick himself, you can go to t3live.com/DOLive to get his free ebook focused on prop trading, the benefits of prop trading, etc. Derrick is a real trader. As he talked about, he's doing a lot of day trading. So let's let him get back to his day trading. Derrick, have a great rest of your day. Everyone else have a great trading day, and we'll just see you back here in a week. Have a good one, Derrick.
Thanks, Greta. Appreciate it. See you next time.
All right, bye.